Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review some overall markets, talk about the stock indexes, some specific stocks, review some technical analysis, go over the bond market, crude oil, review volatility, talk about the currency pairs, and just give you guys a basic grasp and idea of what in the world's going on these days. For starters, we saw the dollar index have a sizable pullback ever since 3 a.m. in the morning, and it has continued going lower, and it has precipitously declined throughout the day. We do see a continued downwards trend, and of course, we have a double bottom pattern. However, a double bottom pattern is certainly not an area of support, because on the third one, there is a high possibility that it could honestly break. Remember, you're only having a 9:30 p.m. window, and for as long as it's within the next 10 hours, chances are this area of support will not even hold. Probably will retest within the next 3 to 6 hours, and even then, chances are it really has a low probability of holding on to it. In fact, let's go back and zoom to the 5-year chart and see a good area of support, and that seems to be somewhere down in the 71, 72, no, more like the 71.49 cents is probably the lowest area we'll probably get. And even then, I really wouldn't depend on it. I really wouldn't anticipate that area to hold. So overall, the whole thesis is here is weakening dollar until we get some information and some clarification out of Ben Bernanke. And chances are Ben Bernanke will not raise the interest rates, inflation will persist, and more importantly, permanent open market operations will continue to happen until we see a sizable pullback in the stock market. We are not going to see a reversal in the dollar index, at least anytime soon. Now let's move on to the next chart, which is going to be the Euro-US dollar. Euro-US dollar is heading substantially higher on the day's trading session. This has been the momentum, this has been the motivation behind the dollar index's pullback. As you guys can already see, the Euro-US dollar did pull back at around 2 a.m. in the morning. That's when the Euro-US dollar had a sizable rally. Therefore, the dollar index had a sizable pullback. Adding to the dollar index's precipitous decline is the US dollar Chinese yuan pair. Now, if you look at it over a 5-year period, you will see that the US dollar Chinese yuan has been weakening over a prolonged period of time. However, 2009 through 2010, even into early 2011, you have seen, or more like towards the end of 2010, you have seen the US dollar Chinese yuan pair trade relatively flat and steady. But right now you're starting to see the US dollar weakening in ground to the renminbi yuan. So what is a good long-term bet in the currency markets overall? I would have to say shorting the US dollar to the Chinese yuan would be your probably be the best long-term trade I could honestly think of, because the trade's relatively flat and then it just continues going lower over a prolonged period of time, over a course of a couple months and years. Remember, all it takes is you to go to China, switch out your US dollars into the Chinese yuan, and there you would hold value. And again, what would that mean for major stores and retailers like Walmart? It would mean worsening margins. However, Walmart does have the world's best supply chain. Therefore, their impact would be somewhat limited and benign compared to people who rely upon China for goods. However, companies with higher margins like Apple, companies that make a tremendous amount of money, whether or not they manufacture out of China or our own backyards in the United States, companies like that will have relatively limited impact. I see impact happening in the clothing area, because clothing has very limited margins, so I'm not too positive on that. Another area that I do feel a little bit leery on is the automotive makers. The companies that make cars and that basically make cars and try to sell them in the U.S. rather than building them in their own plants. However, those type of companies, those type of manufacturings are very few to none. However, I am a little nervous on the toy makers like Toys R Us. Chances are prices of toys will go up, and along with that, overall sentiment is inflation. Therefore, you can only expect prices to go up in the future based on this currency pair that we're seeing in the US dollar Chinese renminbi yuan. Now, moving on, I will go ahead and review the crude oil pair. Crude oil has been going up quite a bit, and I'm going to go ahead and say this is the E-mini crude oil June 2011 futures contracts. Now, the crude oil is trading at around 112.25. Now, 112.25 is a very interesting area. It hasn't been able to break above 114. Therefore, one can only conclude that we could possibly be in a downwards trend. However, seeing as how strong the downward trend in the dollar indexes, and we don't see it abating anytime soon, I have to be relatively positive on crude oil. Sorry guys, there's no hope at the gas pump, at least not for right now. Moving on, let's go ahead and move on to the Treasury bond market. June 2011 has seen a major pullback. I wouldn't be surprised. It did gap up a little bit higher, but again, I really can't be too positive. Remember guys, inflation, weakening US dollar to the Chinese yuan pair always means inflation. Remember, when you get that purchasing power parity going in there, chances are our currency is going to be able to buy much less of those Chinese goods coming in, and people are going to demand the same price and the same currency transaction that they had before. Therefore, they're going to demand for higher prices, and we're going to have to pay up for it. Therefore, the U.S. government is going to have to pay out a higher interest rate based on inflation. That consumer price index number is clearly going up because of our U.S. dollar weakening to the Chinese yuan. And remember, a lot of our manufacturing is done out of China towards the East Coast provinces. Now, because of that, I have to be relatively weak on the Treasury bond markets. I have to have a weak bias on it. Therefore, my bias is definitely to the downside, at least over the longer term and even the short term currently. Moving on, I want to go ahead and review Netflix. Netflix has had a sizable pullback, as you guys can already see. It has traded up to around $240. It has gone down to around $228. It has found support at the 500-day simple moving 50-day simple moving average. I have to say though, I am not too optimistic on this chart. It could bounce off the 50-day moving average. You could probably see it retest into the 20-day moving average for a small gain of around $10 or $12. But would I honestly take the trade? Well, it's up to your guys' risk profile. But again, tech is obviously not the place to be as long as if we're talking about U.S. firms. Again, it's a subscription-based service. A lot of people have been touting it, but I do feel that the margins are relatively limited in certain instances. Remember, you're only charging $10 a month for streaming. $10 a month. If you're a Blockbuster and you rented out 2 DVDs, that's the amount of revenue you would earn. However, the margins are much better for Netflix in one area in terms of cost and cost for revenue. However, the amount of revenue Netflix itself gets from a $10 a month subscription is relatively limited. And again, it makes me really question the amount of growth Netflix can honestly achieve with the $10 a month subscription fee for their customers. There are only so many customers in the United States. There are so many customers you can appeal to in the European continent, and then you have to consider that you basically the markets that it really appeals to are the Europeans, the U.S., and the Canadians, along with the Australians, the New Zealanders, and that's about it. But right now, Netflix is primarily focused on the U.S. and Canadian markets with a little bit of European markets as well. Remember, the Europeans and the US citizens are relatively wealthy, but there are only so many of them. Therefore, you can only sell subscriptions so many subscriptions at an accelerated rate in markets that only have around a population of around 300, a total population of around 800 million people. That accounts for basically around 15% of the world's population. Therefore, again, Netflix's growth is limited, and therefore I have to say it's going to grow, but it's going to start to grow at a much slower rate eventually. Okay, moving on, I want to go ahead and talk about Amazon. Amazon too has found some support on the 20-day moving average. Throughout the intraday, it did touch the 20-day moving average. It pulled back. It had a small candlestick down, and then has been able to go back up. Again, when you see movements like that, chances are you can go ahead and buy into it, anticipating a trade right above or a close right above the 20-day moving average. However, this is a classic double topping pattern on Amazon, and therefore I can't be positive on it. Remember guys, you guys don't trade the story, you guys trade the technicals. The fact is that Amazon is at a double topping pattern. It is finding somewhat of a support at the 20-day moving average, but its earnings have missed. And when you miss earnings, people will punish you for that like no other. People are out to chase yields, they're not out to make friends, guys. And guess what? When you see a company consistently fail to meet expectations for the last 2 quarters, you have to admit, why am I buying this company? The fact is that there are better alternatives, especially coming out of Asia, specifically China. I really like Ding. However, Ding has had a major pullback based on Amazon's results. But I guarantee you guys that Amazon and Ding are 2 completely different companies serving completely different markets. Therefore, I have to say, I am bearish on Amazon, and I'm still on the Chinese bandwagon. Moving on, Vernetics Holdings has had a sizable pullback. It did try to touch 28 again, but it hasn't been able to touch it. It has gone down to the $23 area, and it has touched the 20-day moving average twice in a row. To me, that's not very positive. It seems like we are in the midst of a downward trend on Vernetics Holdings. Vernetics Holdings did have some hype built into it, and I have to say I was really happy at $13 to be buying it. But right now, I can't show that same enthusiasm. We are showing lower highs. We got a low right here, a lower high, and chances are we could break the $22 area and anticipate even lower lows down into the $20 area and even further below that as well. Therefore, my bias on Vernetics Holdings is definitely bearish. Don't buy the stock, and if you have the guts, be free to go ahead and short it. Chances are there's going to be a free fall, waterfall waiting for those, I guess, adventurous traders who are willing to take on more risk for a higher yield. Moving on, volatility index should continue its downward trend as we are seeing the US dollar continue to go down in valuation. So again, that does it for me for today, guys. If you guys are interested in these videos, please be sure to go ahead and subscribe to my YouTube channel. I will have more for you guys in the weeks and months ahead. And if you guys want the same charting software I use, check out the link right below. Take care, folks, and I will go ahead and see you all next time.